Hello ladies and gentlemen, and welcome back. In today's video, we discuss everything to do with markets right now, including the US stock market and the key levels that will move everything around the world. So we have an island reversal. This is one of those big kind of indicators that we've seen before realistically start great rallies, begin shorts, and potentially have big impacts on what's going on right now. We've got large volume going through. We have thrusts. We have a lot of reasons to potentially believe a squeeze is on in these markets. But what happens over the next couple of days could be very important to the overall market squeeze and to the ideas whether we can get back up to fill gaps at 4,100 or whether we sell off this critical zone of 39, 38.80. So we need to talk about everything right now with markets around the world because there is so much data to go through and there's so many things under the hood that realistically will change the way we see markets right now. Well, welcome back everybody to the Daily Show. And of course, in today's videos, we'll be talking about the data, the seasonality, and then of course, the lead indicators and the key levels we should be watching for stocks, commodities, and cryptos. Wake me up when September ends. Obviously, September is one of the worst months of the year. We definitely have discussed that so far. And we've seen that mid-August into September be absolutely shocking. So when we've had the worst 10 SP 500 starts to the year, only one has continued to be negative for the next quarter, 2008. And a lot of people are going to say, yes, that's the one that we're correlated to right now. This is the most similar one. Well, if we were using just statistics, you would say, of course, 90% of the time we would be positive after such horrible starts. And I wanted to talk about this today when we go through some of the data that we're seeing right now. Of course, we know that volatility is spiking. People are incredibly bearish around markets. And you can see this when you look at assets across all of the asset classes, the volatility spike. We're back at levels that we saw in the June and July, and of course, some of the May lows. Now, this is important because when we hit these levels, we often see at least initial turnaround stories, squeezes effectively in the markets. Here are some of the stats when we've seen this cross-asset volatility range go up, and it's better than a coin flip towards the positive side over the next couple of weeks into months. We've also seen huge sell-offs across every asset. In fact, they're so big in sell-offs, it's a record low. The pandemic, the sovereign debt crisis, or the financial crisis never hit these epic sell-off levels across all asset classes, notably, of course, bonds, commodities really getting hit. There was another thing we put up in our last video where we discussed the idea of literally 100% bid rates, where all 100 stocks in the Nasdaq 100 were bid for a day. We saw that Tuesday of this week. Only 6 other times has this happened, and it's generally led on to a small basing of markets. Now, this isn't to say that there isn't a sell-off coming. And of course, all of these stats, we've seen a lot broken in 2022. But as we break this down with other things such as thrust and breadth, it's similar to what we saw in June and July, which marked a at least temporary bottom for the stock markets. Here's some readings for, of course, when we see 5-to-1 New York Stock Exchange up versus down issues. Very bad 1 week result. But the 2 weeks, the 1 month, and the 2 months later were actually quite positive. And of course, the next 12 months were totally very, very good. We've also seen back-to-back days with issues and volume thrusts. And this tended to have a really bad first week, but a really strong kind of next 2 weeks to couple of months. And this is what we're looking at right now. Even smart money versus dumb money, a similarity that we've seen before. A huge switch between the smart money and dumb money in terms of how far they are apart. And before, we saw bottomings on the market. We saw lows. We saw lows. Are we seeing that again? Question mark right now, of course, coming into what is going to be one of the big news events, which is the non-farm payrolls. Smart money versus dumb money spreads. You can see, again, the first week, not so good. The couple of weeks after that, become a lot more positive. So we've got a lot of stats kind of pointing towards this little bit of an uptick here, which is potentially part of a seasonality. Just a quick little random stat for everybody to know. If 2-year yields peak, generally they'll peak 1 to 1.5 months before the end of their Fed hiking cycle. So just remember, the Fed is not expected to stop hiking until at least March and April of 2023. So we're not quite there yet, at least what the market believes right now. So let's talk about September 30th into October. Well, generally, midterm years, we've seen strong upticks. That's the first part of the seasonality. Remember, midterm years also helped us to define that August kind of sell-off. We also see here that years ending in 2 tend to bottom in a very similar period around that time. And if we take all the midterm election years across the board, we have that usually middle kind of August down into September sell-off. And that's pretty much a tick of what's happened this year, similar to that August-September high dropping off during all other years. And this is data taken from 1931 on. I mean, it's amazing to see how many of these things have occurred this year in similarities. Now, of course, data and stats don't necessarily help us out all the time, but they can help us to build a bit of a case of why something might be happening, even though it may not make sense to the news out there. Remember, the news is designed to bring out our greatest fears and our greatest emotions. Fear and greed, they're the really two big things in stocks and markets around the world, and we have to follow those. If we take all the US bear markets since the 1800s, you'll notice the averages, the medians. It's something you might want to pause the chart on. But do remember, we are correlated with 2008. This, if I update this, which I will do, we've got a huge correlation. It might even be more than 91% correlation at this point. And what we're seeing right now is a pickup. Now, is that consistent with 2008? 100% it is. That's exactly what we've seen. And there's probably a little bit more of a pickup and then potentially that watershed moment. So we've got to be very careful here in the markets. But of course, if we're fast and nimble and we have kind of strategies built around risk management, then potentially we can take advantage of a squeeze that could be coming through here because of all the options, all the selling, and all the negative sentiment out there. Here is an idea as well of why this might be happening. S&P 500 stocks above the 200-day moving average. It was low. It was on our bar. It was on our level where we saw turning. We also saw the S&P 500 hit the 200 SMA on the weekly. If you want to, go and have a look at that on your charts. Put the 200 SMA weekly on and you'll see that it was a massive turnaround level for many, many, many years in the US stock markets. We've also seen the VIX kind of start to spike here again, but it's been kind of clawing its way down recently. And usually we have two levels so far in 2022. We've kind of got that 35 level where we've seen spikes of the VIX, usually synonymous with the lows. And then we've seen it come back down between that 20 and 23 level where we've started to see a pickup of volatility again. Now, will that happen again? I am still looking for that one capitulation to hopefully put in the low of 2022-23, which will be a massive spike. I want to see a 45 plus VIX at some point, and I'm sure a lot of you out there will. Usually that comes with some kind of watershed moment, and when that occurs, you've got to be ready, you've got to have a plan, and you've got to know what you're doing because, of course, watershed moments are very, very much appearing to our greed and our fear, and of course, the fear will be absolutely extreme at those levels. So what about the US 2-year? Well, the reason why the market went down over the last 24 hours has to be to do with the US 2-year. The 2-year went up, the stock market started, going down a little bit here. Now, if we continue to see the 2-year go up and the stock market squeezes, the possibility of a sell-off becomes more and more and more apparent. We've seen this a few times in 2022, where we've had basically a 2-year going up, and at the same time, we've had a stock market going up. This is the S&P 500 overlaid, and you can see the result. It really helped us to build that case that the markets were going to turn over and that there was no Fed pivot. But at this point, coming into the non-farm payrolls, we're going to need to be looking at this. Let's take a look at the bonds market. High yield corporate bonds, technically risky debt. It's picked up again. It's actually finding some form of support. If this makes a new high through the next session, you've got to consider that as a semi-positive here for markets. Bonds are coming back. And the reason why bonds are coming back in some form has to be to do with this Credit Suisse situation and the Bank of England stepping in on those pension funds. They're breaking the system again. They're destroying everything. You may not agree with me, but basically what they've told the market is, guess what, guys? We're here. We're going to do everything we can to support it while also trying to combat inflation. It's like having a pegged level, a fully manipulated market. And if you don't believe me, I think most of us would agree this market should be down 10, 20, even 30% more than it is right now during normal times when the market didn't believe that there was a central bank sitting behind, potentially willing to do some QE. And I think that's what's happening right now. Even though the Fed says they're doing hardline, they would switch like that if necessary, if they had to try to support it. So here we see investment grade corporate bonds, a little bit of a drop thanks to yields going up. But I can tell you from my bond indicators, the way that I look at them, we've actually seen another green day on the bond indicators. So could that be pointing towards further bullish pressure here on the markets? We'll take a look at that very, very soon. TLT treasuries continue to struggle. This is the 20-year treasuries. They're still in the demand zone. We've seen them pick up. We've seen them come down. There has not been one green day or one green week here for quite some time on TLT. So TLT in the demand zone. Some people are looking at this, but don't expect big returns on something like TLT. What about the dollar index? Well, the dollar index has hit a level of supply. You can see that when it came down, it held around this level and then eventually busted on down. We talked about the reversal here. It's since reversed and moved into a very key level between that 112.28 and 112.50. There should be some sellers, some supply coming back in. And what's this ahead of? Non-farm payrolls. So we're on a very key level. If we break this zone, we should move back to 113.50, and you would expect the stock market to struggle around that area. But this is a turning area, a critical zone ahead of big news, ahead of that non-farm payrolls. Same with gold, struggling between a supply and now currently a demand, basically trapped within two zones. Until it breaks either side, we won't know whether it's going towards the next level of 1678, 1675, or it's moving to the next level of equilibrium, which should be somewhere around 1758. So gold is really at the precipice of a big turnaround. A few people will probably say, looks like an inverse head and shoulders setting up. Absolutely could be. If it breaks out, I'd expect it to pull back either to here or to here, and for us to see huge turnarounds in gold. Gold could be absolutely coming alight after this non-farm payrolls event. What about oil? Well, we saw OPEC cut the barrels. They manipulated it. It got really close to that 90 level, the supply up here, and it's pulling back down at this stage. If it breaches here, it should move up fairly aggressively, and we may even see upwards of like $95 or $98 a barrel. But if it pulls back, we've got some key levels. We've of course got this demand here and this demand here, and they sit around that kind of 87 and 85. So during the event, there's a real possibility that we may see oil spike these zones and find some pickup power. Watch the dollar index synergize it together. Let's move over to silver. Nothing much going on here. I still require, and I think a lot of us are talking about it getting above 22 to really solidify its bullish, but people are seeing this as an initial positive. Remember, silver took off slightly before the stock market bottomed. March 16th, 2020, we saw a turnaround, and then of course, we got that 23rd and silver ran and ran and ran. It's considered not only a precious metal, but also a key part of economic health. Another one to watch around this period would be copper and to see what it does. If copper strengthens and breaks above here in certain weeks, we really could be seeing some form of significant bottom. But if copper continues to weaken while the stock market goes up for squeeze reasons, then you know that it's most likely a fake move. And you can, of course, use copper a lot to synergize. Subscribe to the channel. We'll be following copper quite a lot, I believe, over the next couple of weeks. Tesla continues to weaken. We'll go over to stocks here, then we'll get into indices, then we'll talk about crypto. And Tesla is just doing pretty poorly. I mean, the whole Elon Musk Twitter thing's really taking its toll here. Still double topping, still looking towards that 220 ideally for Tesla. You'll see it made a long leg doji. It's got a decent amount of volume in it. The general speculation here is that Elon may need to sell more Tesla to potentially fund Twitter. At least that's what I've heard. Regardless, the technicals look towards that 220. If we go over to Apple, we haven't even got mean reversion yet back to the daily 20 moving average, which has been something that we've tapped many, many times. So you'd have to say it's in the middle of nowhere land at the moment. And if you go down to something like a 2-hour chart, you'll see that we have that kind of small gap to the bottom and gap to the top, kind of like a significant potential turnaround here in terms of islands. It's not a super island on Apple, but it came very close to that demand zone. Apple's not giving us enough information right now, and usually Apple's been a great precursor to certain things, but in 2022, it's been tough. It's been a very well held stock, and it's kind of defensive at this stage. DAX, huge volume coming through. Again, it's come off, but there could be some more squeeze potential back into this trend line that we've used a few times to figure out where the topping of markets has been. So we'll continue to watch the DAX, but it does still look like it's broken through, it's pulled back, and it's on a critical support ahead of the non-farm payrolls. Will it be able to move up? I mean, that's where it's basically sitting. Semiconductors have definitely done an island reversal. Again, bad last 24-hour candle. If we snap that candle and get a new high, you've got to think squeeze is on for these markets. Certainly semiconductors can show us this. They're not really huge volume anymore, but yeah, a new high past 204, probably worth an alert. I'll just chuck one there just to show you guys how I think about things. If markets do break these kind of levels, what's that telling you? They're probably willing to move to the next level, and that could push us into 215, filling that gap that's kind of up here. That would be a serious move if that did occur. Let's move over to the UK 100, similar to the DAX here. We've got kind of that inverse head and shoulders on the smaller time frame coming off an incredible defense zone. We've still got an alert underneath here because we know that's where that watershed moment could occur across all markets. But when we scroll down into things like a 2 hour, you can kind of see the base forming, these potential left shoulder, head, right shoulder kind of concepts. We're kind of sitting right on that support. We need a new high, we need above 7,100, and that should solidify a decent move, probably quite a few percentage points above that area. We'll move over now to the American market, the most important of all. We'll look at the 2,000 smaller stocks, the Russell. The Russell not only has big volume on it, but it actually hit a very similar low. In fact, the Russell was nowhere near as weak as things like the Nasdaq and the SP500, which made significant new lows. We've got a double bottom. We've obviously breached to the upside. And at this point, we've found buyers, but of course, we've weakened a little bit recently. If we scroll down to the smaller time frames, you'll notice that there's some pretty decent kind of previous resistances that could be found here in the Russell. And it also broke past this high, kind of pointing towards it maybe wanting that 1800. So is the Russell telling us early that the market wants to actually rally and squeeze everybody out of their short positions? It's very potential here of getting higher. What about the Nasdaq? Again, higher lows currently on this market. To really solidify weakness, we need to see a lower low. Don't get me wrong, bears, it could happen. If it gets underneath here, significant, move towards the gap, pull back, and then potentially place some shorts. That could be all we get. But at this stage, we're making higher highs, we're making higher lows or higher peaks, and we've got serious squeeze potential into things like 12,000 or even back above that zone, which may seem completely ridiculous right now, but it's what we've seen in 2022. Let's have a look at the US market, this S&P, the most important. Decent volume coming through on the lows. Last time we saw an extreme volume through this low. That was huge. That showed us that that island reversal was probably some big players, some composite man, some very strong, big, heavy lifters buying into the market. Again, we've seen decent volume around these lows, showing us that there could be some accumulation coming back into these markets. Kind of similar to here, where we did see a little bit of a ramp. So if the markets do continue to go up, where are they going to hit? Well, it's probably going to be in these levels or the gap fill up here. Those two zones make the most amount of sense. Let's move over to the futures market. And you'll notice at the time of recording, we're getting dangerously close to making a new lower low. And that could change everything here. From being a series of big rallies to a higher high, to a new higher low, ideally, if we hold here. This is kind of signaling towards that idea of 38.80 to 39.20. The first big bear supply that could come back into the markets. If we somehow breach a new low, the rallies could be met by sell demand. So you've got to be very careful around here. It's literally click of a button. Certain things could completely change in this market. But the idea for now would be ideally to move into a squeeze that pushes these kind of zones. We either sell off here or we get a really extreme move. And hopefully we can follow along with this should it happen. Volume has dropped in recent days. You can see that big accumulation is kind of slowed. And this is ahead of the non-farms. I think people aren't willing to risk too much in these markets. There has been reports, though, that massive call buyers saved over here. Like, I mean massive, like 20,000 options or something like that was bought around this period. It's not unusual to see big bets being placed during, I guess you would say high reward possibilities. And they were pushing for a 4,300 and a 4,500 strike. So they were really bullish. Whether they close early, though, is a question that we don't know. What about Bitcoin? Well, crypto is very similar. Crypto's waiting for this news. You've got that absolute critical new high. You can see we've got alerts set for that. Just in case it happens, if it does, could push a real squeeze here on these markets. That's setting around 20,500. We've got the low set as well because the next 24 hours is going to be pretty important to markets. We can see the volume. We can see the potential here of accumulation for a short-term squeeze. And it is really happening in this market. That's the kind of way, we may have to flick and change very, very quickly here. What do you guys think in the comments down below, though? Are you bullish or bearish at the moment over the next couple of weeks? I'd be very interested to see. If you haven't already, follow us at FX Evolution, of course, on Twitter, Discord. You can join our private Discord if you're interested in some of the private streams that we do. And of course, we do have some courses over at fxevolution.com. But the other big thing that's coming, and the one we've been talking about today, is the non-farm employment change. This is the jobs number, and it's a weird world in 2022. Maybe we want to see negative numbers. Yeah, that's not positive, bad numbers coming out for the US, and that could actually set the market going up because it may mean that the Fed is doing its job. The Fed is ruining demand destruction. It's basically what they're doing. It's what they're trying to do. Companies are, of course, employing less. That's what they want to see in the numbers. Now, how non-farm payrolls works. The problem with this number is it's not just the number itself. It's under the hood. Where were the jobs? Where were the jobs lost? All these things have to be calculated by the algorithms, by people out there. So you can often see a market that will go the opposite direction first and then move off, gaining liquidity. Do be careful here. Non-farm payrolls is a dangerous time. It often does this. But if we were looking at statistics, and I'm not exactly sure on this, someone could put it in the comments or send it to me and I'll share it on Twitter if you've got it. I believe that most non-farm payrolls over the last 24 months have been positive outcomes. Even with negative first being the move, they've generally gone positive. Will it be that time again in the markets? We'll find out. But of course, non-farm payrolls, be careful if you're scalping, practice risk management. And if you enjoyed today's video, remember to subscribe, guys. Smash that like button and we'll see you in the next one. Bye for now.